Chairman,
How you doing?
haven't done a podcast with you in 2 months, I think.
Has it been that long?
Great to see your face,
Good to see you.
but the market's been a hell of a 2 weeks.
It's
Let's address that today, should we?
let's do it.
All right. So before we get into the cause and effect, let me give you some numbers, folks that are listening. And this was as of yesterday. Yesterday was a very bad day in the market to begin with, and then it actually finished positive. But at its lows yesterday, the S&P 500 was down 13% from its highs. The NASDAQ was down 18.5%, and the Russell 2000 small cap stocks down 22%. So, and here's the interesting thing of the NASDAQ. 50% of the NASDAQ stocks are down 50% or more.
Wow.
Boom.
Yeah.
So a couple causes, and would love your thoughts on the current situation in the market. The sparking the sell-off has been the fear of the Fed pulling their foot off the gas pedal, which needs to happen, doing too much too fast, raising rates, and also inflation fears. Inflation over 7%, highest it's been since 82, right? Which came off of its high in 1980. Tell me your thoughts on the correction. Should people be worried? I mean, tell me what's going on in the chairman's mind when you experience markets like this.
Yeah. I think the markets have. I think stock valuations generally are, I would say, have been full coming up to maybe the last few weeks. And so when you have historically the market, today's market value is trading at a historically higher price, higher PE multiple, in the mid to low 20s. Historically, PE multiples have been sub 20, 15 to maybe 17%, 16% PE multiples. And what does that mean? A PE multiple is just the price of a business divided by the earnings. It's just, we call it a multiple. So if you have a company that's selling for $100 and has $10 in earnings, it would have a 10 multiple. So you're paying 10 times or a 10 multiple of those earnings. And so today we're paying a little bit higher, and so when we have interest rates have been going up because why? You talked about it, inflation, and we've had a little bit of inflation this because of coronavirus, and our inflation numbers are year over year. So we're looking, last year we were kind of deep in the still coronavirus, and here we are. We've been on the coming out of coronavirus,
and then had a setback and went back in with the Omicron and
right.
Plants shutting down and meat going through the roof prices, and
then we had supply chain disruptions. We shut down for a while, so that is
okay. Let's talk about this for a second. Inflation, because it's scaring a lot of people, and I think it's resetting valuations, right? Along with the interest rates rising as cause and effect. Do you think that it's kind of a tale of two markets? And I say that because I think the correction that we're having, specifically in the NASDAQ, is very, very healthy, because the valuations of that 50% of stocks that's down 50% or more, they were insane.
Yeah, there's pockets of the market that valuations are just crazy. A rational investor, a business owner looking at a business and valuing that business, with those 50, a lot of those 50% companies that are down, 50% or more, would look at that and say that is not a rational price. And there was a lot of momentum, a lot of speculation in the market. Yep. So there's been a lot of speculation going on. We talk about SPACs, we talk about meme stocks, we talk about Reddit, threads and Reddit groups that are promoting stocks, and then we got crypto and Bitcoin
and the stay-at-home stocks
and the Robin Hood crowd.
All right, I'm going to say something, and this I might regret saying this. No, I won't. Late last year, or maybe Q4 sometime, right? So late last year, we had a handful of clients asking us, why aren't you invested in this or that? Because it was on a tear. Those same stocks are down 40, 50, 60% now because of the bubble that you're describing. You can't chase these investments.
Yeah.
Or you'll get wrecked.
Well, and we talk about we just had a meeting just a minute ago with a client, and we talked about we have this process, and part of that process is we put a value on a business before we buy it, and we want to buy it at a discount to the value of that business.
Yep.
And so many of these companies that have been hit so hard, and the values of those businesses were significantly below what they were selling at in the marketplace. And we've looked at some of these companies and how on earth can you buy that company and think that you're buying any sort of value? I mean, a lot of these companies had no earnings, no profitability, and value is derived from profits. I mean, that's how you value a business, is its future cash flows, its future profits. And so many of these businesses didn't have any profits. It reminds me, talking about being the old guy here, it reminds me in some degree of what happened in .com in the late 90s. I mean, there were so many businesses that were trading at incredibly crazy valuations. And then coming out of that, we had this, people sort of woke up to the idea, it was like the emperor was wearing no clothes, and all of a sudden everybody realized, oh wow, he's not wearing any clothes, and look at the valuations on these businesses.
Yep.
And valuations have come down dramatically, and we saw that in .com era, and we're seeing it with some of these game stocks in pockets.
Yeah.
What we buy value, and that's part of what we do, is we're looking for value, and part of that calculation of value is growth. How fast will these earnings grow over the next 5-10 years?
So this market that we're seeing now with the NASDAQ nearing bear market 20%, right? Once the market's down 20%, it's bear market category,
right,
or labeled as a bear market. We were close yesterday, but talk to what that means, or is that a bad thing to the market to have the NASDAQ down 18 and the S&P 13?
Yeah.
Like, is that bad?
No. Well, I think this has been really healthy, and I don't want to offend anybody out there, because we have clients we're invested that are invested. Well, myself, I'm fully invested.
Yeah, me too.
My portfolio's down over the last couple weeks, just like everybody else.
I'm aggressive. Mine is too.
Yeah. So we're not making light of the market being down, but
no, we're not.
No, not at all. I mean, and we know that there's people out there that this really hurts, and psychologically
more than monetarily.
Right. And unless you're one of those people that were owning a lot of those companies in that 50% category, they're down 50%, that didn't really have a lot of value. And in fact, some of them are down 60, 70, 80%, and they might go down even further. So that's why it's so important to buy value. But I think this is really healthy for the market long term. If you're a net investor, if you're going to be, and you and I, we're still in even though as old as I am, I'm still in the accumulation phase. I'm still trying to build wealth personally. I know you are.
Yep, absolutely.
And if you're still in that phase, then you want stocks to be rationally priced. You don't want stocks to be incredibly high and you're paying high prices for your investments over the rest of your life. You absolutely don't. I'd rather have them more rationally priced. So what we've seen is this is a healthy kind of a correction. It's flushing out a lot of the speculation out of the market. I think that's really healthy.
A lot of the excess risk.
The excess risk. And guess what? When you pay less for a stock or less for a business, that's a good thing. You're buying more value when you pay less for a business. In fact, I have a quote here. Let me.
Go for it.
Yeah, this is a quote by Charlie Ellis, who is just a Wall Street legend. He's also I think he was a professor and doctorate of economics.
He's still a Wall Street legend, even though he was a professor.
Yeah, he's a pretty. I know it is pretty rare.
I'm sorry,
but actually it is pretty rare. But he said, if you're buying something Wouldn't you rather pay less for it than more? When stocks get cheaper, how can that not be good news for a long-term investor? There are very few times when you should be bold, and history shows that those times are precisely when it seems you should be most afraid. It's absolutely, if I can say this right, absolutely cockamamie. Did I say that correctly?
He was close.
Crazy to sell stocks after they drop. Instead, you should say, today there's a first-rate bargain and I'm buying. And that's really the attitude you should have, is when stocks are on sale. Buffett's always said, buy your stocks like you buy your groceries when they're on sale. And that's exactly how we think about it. If you're a net investor, meaning you're going to be investing, still trying to accumulate wealth, you want stocks to be rationally priced, to be reasonably priced. You're not overpaying for your investments. That if you have a $500,000 portfolio today, and you think in 10 years from now you think your portfolio will be, say, worth $1 million, as it grows and it grows in value over time, does it matter in the long-term scheme of things, does it matter if it's down 3 or 4 or 5% today or tomorrow?
So those that are still in the accumulation phase of life, like we are, right? Putting money in the market, planning for the future, need growth. We want this. We want the market to go lower, right? So there's that group of people, exactly what you just said. Like, this is when you buy. We've got 50% of our portfolios trading below, or say 20% plus below its intrinsic value, right? I mean, it's great deals right now.
Right.
But
they could get better.
They could get better.
Cheaper, right?
But then there's still those that are done with that phase of life. They're retired. And I want to speak to those people in a minute. Okay? Not right now, but in a minute, because we need to put this into perspective. The NASDAQ was down 18.5%, which some consider the NASDAQ the market because tech stocks are so much, they're the majority of the market.
Their influence,
the market cap.
Their influence on the market's big, yeah.
So here's what the S&P over the last 100 years has experienced on average. Okay? There's a correction of 10% plus at least every 2 years. Okay? Normal. We're seeing that right now. We did not have that last year. We have that this year.
The market was down, I think, 5% last
5%
year.
of its low. At its low. Yep. And we're down 10%. Yeah, so we're hitting that. Once every 7 years, we're down 20% plus. Okay, so that could occur, but it happens every 7 years. So plan psychologically for that. Now, a 30% plus correction happens every 12 years on average. And so we had that 2 years ago. 37%
in the
correction
in the spring,
yep,
spring of 2000
of 2020. So
2020.
This is normal. This is normal market behavior, although it hurts when it happens, especially to that group that is retired. So we've talked to the accumulator. Hey, if you got any cash lying around, gosh, call us. Send it in. Call Katie and her team. They're fantastic. Send it in because we got stuff to buy. But if you're retired, what would you say to retired people?
Yeah, can I?
Because it's a little bit harder.
Yeah, backing up on the people still in the accumulation phase. Call us, yes. Call Katie. We'll put that money to work. It doesn't mean that the market hit its low today or yesterday.
Could go lower.
It could go lower, absolutely. But we're looking at values from say 3 years, 5 years, 10 years. I mean, we're not looking at this like, oh, it's a great bargain today and tomorrow it's going to be up. That's not what we're thinking.
3 months or 6 months, no.
No, we're looking out the next 3, 5. We think, yeah, there's some good investment opportunities today if we're a long-term investor.
Yep.
So for those people who are in the distribution phase of life, they're living, they're not accumulating income, they're not accumulating assets, they're spending their assets.
They're living off of their portfolio.
Right, living off of their hard work over the last 30, 40 years. I mean, it's absolutely super important that we do a great job for these people. We take it very serious. We have a cash management strategy that we want to set aside your cash needs for the next 2 years, at least the next 2 years. So typical bear markets, what is it, 14, 18 months, something
Yeah,
like
14
that.
months.
14 months.
Yep.
We want to have cash on the sidelines that we don't have to dip into your stocks or dip into your investments when when stocks are down. And so we want to have, if you're in the distribution phase of life, we want to have liquid assets available to you that we can access without having to sell stocks if they're down.
And so what happens, and those that are clients have experienced this, when the market's trading at all-time highs and say, investment that we love within a portfolio goes from 10% to 18%. Okay, time to take some of that off the table and move it in cash to replenish what they've been living off of.
Right.
When the market's down 10, 15, 20%, we stop doing that. You live off the cash, because who knows how long, on average it's 14 months, but let's plan 24 months.
Right.
So they can live off the cash while the market recovers, allowing us to open up more cash.
Mm-hmm.
So that group of people, we're mindful of you. We understand it stinks. Any correction stinks, even normal, healthy corrections that we're seeing now. But know that you're at the forefront of our minds for sure.
Yeah, and this has been quite an amazing, couple years in the market. We've had, what were we up in 2020? I mean,
The last 5 years we've averaged 18%.
Yeah, it's been pretty good.
Not as good as the last the last bull market.
Yeah.
From back in the late 90s or early 2000s, but
yeah, I know that a lot of people like to anchor, they see their high water mark on their investment portfolio.
Recency bias.
Yeah, the recency biases. They look at that and they keep thinking, oh, well, that's what it was worth, and now I'm down, say 5 or 10% from that number. And of course, everybody does it. It's human nature that everybody does it. I can tell you that when I look at that number, I always shave 10 or 20% off of that number and say, well, I don't really believe that number. I shave 10 or 20 because that's just what the market's going to do.
Yep.
It's going to correct 10 or 20% every so often. So whatever your portfolio is, what it was maybe a couple weeks ago, or a month ago when it was near highs, shave 10 or 20% off and say, okay, that's really my number. But a year or two from now, that 20% is going to be, hopefully a little higher.
A lot higher.
Yeah.
So we're doubling the money every 7 to 10 years, right?
Right.
Or you can just put, if you're still in the accumulation phase and your account goes from $1 million to 800,000, just find 200,000 to bring it back up to $1 million.
There you go.
Deposit the money.
Prices are attractive. I would prefer, I wish the market would trade at a reasonable value all the time, just to be fair to everybody. To be fair to, people in the distribution phase and people in the accumulation phase. I say that sort of in jest because I do like, there are incredible opportunities in financial markets and stock markets because sometimes the market gets irrational.
Yep.
We saw
That's the beauty of the market.
That's the beauty of it.
But those in retirement have already taken advantage of that. Now they're in retirement, so it's a different strategy.
Right.
Now those that are in the accumulation phase like we are, we're taking advantage of the craziness of Mr. Market.
Mm-hmm.
But when we're in retirement, we'll have to adjust our plan like we do for our clients, right? And it's, hey, you had your turn, let them have their turn, but we have a strategy for you. Right.
And then I think the other thing that I always remind myself and try to remind clients and customers and friends, all our clients are friends, is we own businesses. You're a business owner.
Yep.
And just like the farmer that has a farm and having a bad year, he's not going to sell his farm because he had a bad year. It's, you're going to have a good year next year. You're going to have, 7 or 8, 9 years out of 10, you're going to have good years. Every once in a while, you're going to have a tough year. It doesn't mean you sell the farm. You still, if you own a good business and it's going to grow over the next decade or 5 or 10 years, you're not going to sell it. I don't know why you would sell it. That's a completely irrational behavior to sell a great business just because you're going to have one or two bad years out of a decade.
It's the psychology behind it.
But because it's so easy, everybody gets sucked into it.
Yeah.
It's so easy. Just push a button and you're out.
Boom. So we've addressed the correction. normal correction, at least at this point, from what we can tell. It could change. Don't think it will, but it could. Those that are in retirement and those that are in accumulation, what they should be thinking. Okay, so any other words of wisdom for people going through this market correction?
It's just stuff we always say. Keep a long-term attitude. I'm in it for the long haul. You shouldn't. There's a good quote here by Charlie Ellis. If you don't plan on staying married, you should never get married. In the first place. And that's kind of how we think about stocks. If you don't plan on being in stocks for the long term, you should never be in stocks. I also heard Buffett say that something along the lines, if you're going to do something stupid when stocks go down in price, then you shouldn't own stocks. You really shouldn't be in stocks. And really, to sell stocks when they go down is actually it's a really bad idea.
The market has provided 18% per year for the last 5 years. The volatility that we're experiencing now is the price that we pay for 18% returns.
Yeah.
If we can't handle this volatility, then we don't deserve 18% returns.
No.
And so if you're afraid at home, turn off your computer, go for a walk, go snowshoeing, go bench press cars like you. I don't know.
One last tidbit of advice is this is from Buffett.
Of course.
Buy your stocks like you buy your groceries when they're on sale. And
here's the problem right now. There's no groceries on sale.
That's true.
Inflation.
I know, inflation.
My wife just called me from Costco about some beef prices. Yeah. I'm kidding. I don't mean to blow up your quote because that's 100% accurate.
No, but that's a good point. I mean, groceries are expensive.
If you can find those on sale, buy them.
But when groceries are on sale, you should buy them. And stocks,
100%.
And some stocks, really, really high quality stocks are off. I mean, the lower quality, lower value stocks are off 50-80%, but a lot of high quality, really good businesses are off 10 to 20% right now. Those are the businesses that we like.
Yeah, absolutely. All right, my friends. Well, thanks for listening. Hopefully this brought some peace if you're a little bit worried, and some guidance. And if there's anything we can do, certainly reach out and Brian will be happy to help you.
Okay.
I'm kidding. I will too.
Katie will.
Yeah, for sure. All right, folks. Thanks. Until next time. Bye-bye.